I'm Jamie Dinan. I'm the founder and CEO of York Capital Management. I founded the firm in 1991. Our beginnings were quite humble. I raised just under $5 million from a number of friends to help me get started. Today, almost 21 years later, we now run a global money management firm specializing in event-driven investing with offices, quite frankly, all over the world and $15 billion of investors' capital.
York invests in three primary strategies: merger arbitrage, which is where one company is taking over another company; special situations equities, which include spin-offs, industry consolidations, and credit investing, primarily in distressed credit. We invest long and short in credit and equity. We do that on a global basis in North America, Europe, and Asia, as well as some parts of Latin America. One of the advantages of investing in event-driven securities is that they really tend not to be market dependent, because we specifically value securities based on a catalyst. So it may be an acquisition, it may be a spin-off, it may be a company bankruptcy. Two of our strategies tend to be counter-cyclical. In periods of market turbulence or a recession, we tend to invest more in distressed securities. In bull market or up market periods, there tends to be more merger activity. So there's always something to do in the event-driven space.
I think the big differentiation of York is its research focus. I mean, we are really a research-driven organization. The firm has over 50 professionals, dedicated to the investing and trading operation. I think roughly 85% of those professionals are basically in the research side. This is a firm with deep fundamental research, is what gives us the edge. We examine lots and lots of opportunities, and we tend to do a very, very good job at focusing on the ones that actually will, I think, provide good risk-adjusted returns. But at the same time, we do make mistakes, we get things wrong, and we're incredibly disciplined at cutting our losses. And likewise, we're incredibly patient to let our winners actually work out.
Our analysts look at news flow, information, we look at periodicals, and we do fundamental analysis, valuing companies, looking at specific transactions, and looking at what a company might be worth on a pro forma basis after some form of catalyst. And that may be a merger, that may be a spin-off, or that may be a bankruptcy in the distressed credit space. We
globally, and we're almost a 24/7 way, just read everything that we can. It can be company announcements, it can be media reports. In fact, in many ways, the more obscure, the better. If something's in the Wall Street Journal, the Financial Times, it's pretty much efficiently priced, almost instantaneous. So you want to be reading through, press releases that are somewhat obscured, industry publications that, quite frankly, there's a delayed reaction to. Those are oftentimes where the real nuggets are. A lot of the big opportunities come, though, from really derivative ideas. So you may read about, there's, news, let's say oil's discovered in hell, let's say. Well, of course, all the oil companies that do oil in hell are going to immediately jump up. But what happens is, a contiguous field in purgatory that no one's paying attention to. And instead you go, what, if oil is discovered in hell, my geological research tells me there has to be parts of basically southwest purgatory. And we might start buying those in anticipation of news coming out in next week, month, that oil is discovered in southwestern purgatory. That's increasingly where the value add comes from. Thinking not at what's happening today, but really what could happen tomorrow. I think the other thing that's important when you look at opportunities is increasingly, if it's what we call formalistic investing, where you basically put into a calculator, put into an Excel program to get the answer, there's no real value there. Increasingly, the value add comes from this big thing called judgment, personal judgment. And that comes from not just, I would call intellectual academic smarts. Most people in this industry are. It comes from what we call street smarts as well. And then lastly, experience. I mean, there's an enormous amount of experience that really comes into play. Mark Twain had a great quote, which was basically, history doesn't repeat itself, but it sure does rhyme. And the more experience you have, the more you hear the rhythm, okay? The more you see the patterns, not just in terms of making money, but also in many cases, avoiding losing money.
York is focused on risk management. We have three primary principles. We run portfolios that are extremely liquid. We run diversified portfolios, and we also run primarily unlevered portfolios. We think that these three characteristics mitigate some of the risks inherent in portfolio management. We've never gated or suspended any of our portfolios, and one reason for that is the liquidity inherent in our portfolios.
Our institutional funds are broadly diversified. They tend to have 50 to 80 positions at any given point in time. Typical position size is going to be between 1 and 5% of AUM. 5 is on the high side. And as a result, what that allows us to do is not only have a broadly diversified portfolio, but most importantly, as all firms, we make mistakes. The thing about New York is no one mistake is going to crush the firm. That's the idea.